Welcome to the deep dive. Today, we pulled together quite a stack of sources, really showing some tectonic plates shifting across tech and the economy.
Yeah, it looks like a busy feed.
It is. We've got 11 critical posts lined up. It's dominated by, well, huge structural changes inside top AI companies, and also some pretty unsettling news about mass layoffs.
Right. And that political pride data point you mentioned sounds striking, too. We've got major implications to unpack here. The plan is to move quickly, but analytically.
Exactly. Cut through the noise, get to the so what.
Let's avoid getting bogged down. Focus on what really matters from these posts.
Absolutely. Let's kick off with the AI giants. OpenAI specifically, and this big corporate reshuffle. Post one from @Andrew Curran mentions OpenAI completed its recapitalization, and they renamed the nonprofit. It's now the OpenAI Foundation. We also get a first look at the ownership numbers.
Yeah, and the crucial number there, the one that jumps out, is Microsoft's stake. It was diluted from 32.5% down to 27%. That's in the new $130 billion for profit structure.
Okay, 27%. But then post 9 from @ReachVB seems almost celebratory about it. The text says, OpenAI is now able to release open weight models that meet requisite capability criteria. So what's the connection?
That's the trade-off, right? It looks like less equity for Microsoft on the surface, but the new deal extends Microsoft's IP access. They get the top models, the best products, through 2032.
So they traded a bit of equity for a longer guarantee on the really advanced stuff, like an insurance policy.
Pretty much. And in return, OpenAI gets this flexibility. They can develop non-exclusive products, which includes these open weight models you mentioned.
Right. Open weight meaning the key parameters are public, so developers get faster access, the ecosystem speeds up.
Exactly. Microsoft locks down the high end, but the broader community gets a boost. It's a balance.
We should quickly note, post 8 from @WatcherGuru just confirms that 27% stake. Simple confirmation there.
Right. But it does bring up a bigger question about Microsoft's strategy overall. Even with this guaranteed access, some analysis, like I think it was an MIT study from 2024, it suggests Microsoft's kind of fragmented approach, juggling Copilot, their Phi models, this OpenAI deal, it might be less efficient.
Less efficient how?
They'd be 15–20% lower innovation efficiency compared to rivals who are just laser-focused on AGI, on artificial general intelligence.
Interesting. So that fragmentation has a real cost, even with this deal.
Potentially, yeah. It's something to watch.
Okay, let's pivot within AI, away from ownership towards content. Grokipedia. Post 3 is from @Elon Musk himself, asking how to fix mistakes in Grokipedia.
Which is fascinating, right? The intent seems to be crowdsourcing corrections, like letting users flag and submit fixes for AI errors.
Yeah.
Trying to mimic Wikipedia's model, essentially.
Okay, crowdsourcing fixes. But then post 7 from @MXPhrase make this incredibly bold claim. It says, Wikipedia stays updated with real-time edits powered by Grok. No human bias and no errors.
Yeah, no errors. That sounds ambitious. Let's call it marketing speak. It's already facing a lot of scrutiny. Remember, it launched October 27th, pitched as this bias-free alternative after Musk criticized Wikipedia.
Right.
But reports came out almost immediately about server crashes from traffic and, crucially, factual inaccuracies.
Like what?
Like apparently misstating Musk's own role in founding Tesla, which, kind of taints the no errors promise right out of the gate.
Yeah, that doesn't inspire confidence.
It really shows that even if you try to remove human bias, you can end up introducing completely new systemic AI errors. It's not straightforward.
That's a rough transition, maybe, but that instability seems to mirror what we're seeing in the labor market. Let's move to segment 2, the labor market paradox. Post 2 from @CoBasilletter lists just a brutal set of recent layoff announcements. UPS cutting 48,000 people, Amazon up to 30,000, Intel 24,000, Nestlé 16,000, Accenture, Ford, Microsoft, PwC. The scale is just wow.
It's staggering. And you need to put that in context. That list, it's just part of over 170,000 layoffs announced in October 2025 alone.
Just October.
Just October. It signals a really drastic cooling in the U.S. labor market. It's serious.
And is it AI? People always worry about that. Amazon mentioned AI integration.
Yeah, they did. But the wider data suggests something else. Only about 1% of firms are directly blaming AI for layoffs right now. The much bigger drivers seem to be, old-fashioned cost-cutting and shifts in broader economic policy.
So companies are just focused on boosting margins this quarter.
Pretty much. Which brings us right to the economic irony in post 5 from @BoringBiz.
Right. The question was, so if we lay off everyone to increase margins this year, who will have money left to buy your products next year?
Exactly. It's the core strategic dilemma for businesses today, isn't it? You make these cuts for short-term shareholder value, maybe boost the stock price for a bit, but you risk completely eroding the consumer base you need for future revenue. Who buys the stuff? If you connect this to the bigger picture, like the World Economic Forum's 2025 jobs report, it highlights this weird paradox. Even though maybe 92 million jobs could be displaced by automation.
Wow, 92 million.
Yeah. But at the same time, demand for uniquely human skills, complex problem solving, emotional intelligence, creativity, that demand is actually increasing rapidly.
So companies cutting deep just for cost savings.
They might be cutting the very skills they'll desperately need to navigate this automated future. They're fixing today's balance sheet by potentially wrecking next year's business.
Solving one problem by creating a bigger one down the road.
You could say that. It's a dangerous trade-off.
Okay, wow, that's a lot to process. Let's shift gears hard now. A few quick hits from the feed. First up, post 6 from @ItterIntellectus. It's about screen resolution. The claim is 4K is more than enough. 8K only matters if your face is glued to the screen. Anything beyond that is a waste of money.
And you know what? The science actually backs that up pretty strongly. There was a study, Nature Communications, I think just out October 27th. It looked at the human-eyes resolution limit, the FOVIA.
Okay. Wow.
It's about 94 pixels per degree. At normal viewing distances, like 1.5 to 3 meters from your big TV, 4K resolution basically hits that limit. Your eye literally can't perceive more detail.
So unless you're sitting way too close or maybe using a VR headset right up against your eyes.
Exactly. Then 8K might make a tiny difference.
Okay.
But for most TV viewing, your eyes can't process the extra pixels 8K throws at you.
It just becomes a number on the box, an expensive one.
Precisely.
Yeah.
Not really a tangible benefit for most people.
All right. From pixels to the pitch. Football.
Cool.
Post 4 from @Fabrizio Romano. It's a quote from Chelsea manager Enzo Maresca about João Pedro. He says, he is not going to score 20 goals a year. He's a different striker profile.
Yeah, this is clearly about managing expectations. Pedro came in with a huge £60 million price tag in the summer of 2025. And apparently he hasn't scored yet. So Maresca's basically telling the fans, look, he's not that kind of striker.
Not a pure goal scorer like, say, Haaland.
Right. He's saying Pedro is more versatile, maybe more assist-oriented, good at link-up play, a creative type, not just a finisher.
So it's about fitting the player to the system, not just buying goals.
Exactly. It's about tactical fit versus just raw stats. Important clarification.
Okay, next, Tesla. Post 11 is from @Tesla itself, just promoting the annual meeting on November 6th. Seems straightforward.
The post itself is straightforward, yeah. But the context around it, less so. There's significant frustration bubbling up from owners, especially those with Hardware 3 or HW3.
Why HW3 specifically?
Because they paid a lot, often years ago, for the promise of full self-driving, FSD. And it just hasn't fully materialized for them. It's this gap between the marketing promise and the delivered reality.
So what's the latest?
Tesla recently confirmed a delayed, sort of elite version of their next software, V14, specifically for HW3 cars. But it's not expected until mid-2026 now. And this is happening while there are ongoing lawsuits from owners about these very delays.
So the meeting promotion lands right in the middle of that ongoing tension.
Exactly. That context is pretty crucial.
Got it. Okay, final item. And this one is, well, pretty sobering. It's about national pride. Post 10 from @RealChrisRufo summarizes some poll data. It says, the share of Democrats who are very proud to be an American fell from 90% to 36%. This is catastrophic for the country.
Right. This draws on Gallup poll data, looks like from June 2025, and that divergence is massive. You have Democratic pride plummeting 90% back in, say, 2001, down to just 36% now. Meanwhile, Republican pride has stayed pretty steady around 90%.
And overall pride?
Overall, U.S. pride is at a record low in this poll, 58%.
Why the huge drop specifically among Democrats?
Well, we should be clear. We're just reporting the data and the source's interpretation here. Gallup suggests the decline since around 2015 might be linked to a heightened awareness or focus on social and racial inequalities.
So different perceptions of the country's state based on political alignment.
That seems to be what the data reflects. A really strong bifurcation in feelings of national pride, potentially tied to these broader societal issues.
Okay. We've covered a lot of ground today. From, the deep financial shifts in AI.
Yeah, the OpenAI and Microsoft deal.
To the really stark economic impact of these mass layoffs.
And that disturbing question about who buys the products.
And finishing with this surprising and potentially concerning data on national identity and pride.
It's quite a mix. And as we wrap up this deep dive, maybe here's a final thought to leave you with, something to mull over. We talked about these mass layoffs,
Yeah.
often framed as necessary for corporate stability, right, to fix balance sheets. But if those very actions are simultaneously destabilizing things for hundreds of thousands of people, their job security, their ability to spend, is it possible that that economic instability, that break in this sort of economic contract, is actually a hidden driver behind this decline in national pride we just discussed?
Mm. You mean the economy directly impacting how people feel about the country itself?
Could it be? Is the economic insecurity shaping cultural identity and national alignment in ways we haven't fully grasped? Something to consider as you process all this?